Hello and welcome to the show. We call this Molotsky on Money. What's the show all about? The clues are in the title. We'll be discussing money, specifically investment strategies, taxes, estate planning, insurance, and many other topics, all of it designed to help you and your family improve your overall financial picture. The Molotsky part of our title comes from our panel. Their name is Molotsky. What a coincidence. Each week we'll have Stan Molotsky, president and founder of the SHM Financial Group, as well as Lee Molotsky, Vice President of the SHM Financial Group. Stay tuned because tonight we have a lot of valuable information on the show, and we hope that you and your family and everyone can benefit from. Stan, I must comment on your great suit.
Thank you very
tonight.
much.
See, I start the show with a financial question, but we have to talk about your wardrobe, which is, not that yours isn't good, Lee, but
That's right.
I mean, outstanding. I might try to come steal that from you.
Picked out by my wife.
Give the wife's credit.
Yes.
There are, unfortunately, as you've said many times, a lot of challenges in today's world in terms of financial issues. A lot of challenges for people, a lot of pitfalls, and we're going to talk about those challenges tonight. How do you help people navigate the muddy waters of financial challenges these days?
Well, there's so many things that are constantly being thrown at so many different people that they were not necessarily prepared for, but didn't exist in years past. So the key to the financial planning process, or putting money in any kind of investment vehicle, is to make sure that you can adjust it based on a variety of different circumstances. And there are so many different circumstances. You know, people living longer, inflation, the needs of children and grandchildren that are greater than they've ever been before. All these things have to be factored into what people do with their money, and they always have to be prepared to have some form of an exit strategy.
And we're calling tonight's show the most important financial challenges in funding your retirement. And I guess, Lee, it's not just funding your retirement, but just to really try to save money or to try to navigate through the world today.
Yeah, it's the navigation.
Right.
It's financial planning or financial strategizing is really not just like using a GPS, punch in where you want to go and it'll get you there. There's too many factors that go into, too many negative issues that you have to be aware of that may affect you, in a not so positive way. So.
Okay, we're going to get right to it here because we have a lot of points to cover for you tonight on the show. Again, the most important financial challenges to funding your retirement, and let's go to the first one here, and that is uncertain longevity. Stan, what do you mean by that?
Well, going way back, it used to be you planned till someone reached 65 or 70, and then you went from 70 to 75, and then it went from 75 to 85. And now in our planning process, we make it so that there's funds available at least till 110. So it's a planning based on the longevity that's being created by our health system. So you have to be prepared for all that.
Wasn't it years ago when it was FDR created Social Security? The average life expectancy was 68, so you retired at 65, you had 3 years. So you didn't really have to worry too much about it, right?
Exactly. And as things expand, a lot of the planning factors are still based around those old numbers, that's 68 to 70 to 72, and things constantly keep changing.
So again, Lee, as we've said in other shows, you got to plan, okay, hopefully you live till 110, but you have to plan pretty far out.
Yeah, we use 100 to 105, but let's say 100 to make it easy. And you really have to be careful to this is strange to say, not overstay your welcome, so to speak. You have to.
I mean, without money is what.
Yeah,
you're
without
saying.
money.
Right.
Yeah. Obviously, you want to live as long as you can, but you want to live the right lifestyle. You want to make sure that you're not overdoing things early on, which could really affect you negatively. And you also there's something called a sequence of events or sequence of returns that could dramatically affect the actual how much you have left at retirement. And you want to be careful, really, really careful early on that the sequence of returns, which you really almost don't have any control over, you want to make sure that they're not negative. So what does that mean? In strategizing, the longevity, the uncertainty of the longevity we can't control, but what we control is what makes up the asset picture and what we can do about the assets to restructure them so that you're okay.
Okay, we're talking about the most important financial challenges to funding your retirement as we move through these here tonight on the program. This is number 2, insolvency risk of institutions backing retirement. This is a good one because in the news recently, we've heard about some cities, Stan, being bankrupt. Is that what you're referring to here?
That's part of it. I mean, you have that, and you have certain states that fund retirements, along with, you know, such as Detroit, which filed for bankruptcy, and other cities throughout the country that have also filed for bankruptcy, and that affects the pension and the health benefits of a lot of the employees of those particular cities, and potentially other cities, and even in some cases, some of the state benefits that people have been counting on. So as you count on those things, you constantly have to make adjustments to protect yourself against having all of the money in certain kinds of situations. So you can't rely totally on any one thing.
So what you're saying is you can't control a Detroit or a state from going bankrupt, but you can control your own finances to a degree.
Sure.
So kind of act like those things may not be around. Is that pretty much what
Well,
you're
sure. I
saying?
mean, if you go back to 2008, 2007, you had companies that disappeared, that went out of business, that would have been impossible to think of. You know, major brokerage firms, major banks, major entities that were forced to reorganize, such as that company that used to be that so goes General Motors, so goes the nation. Well, guess what? You know, General Motors went into bankruptcy and has come out of bankruptcy, you know, better than they were before because they got rid of a lot of different obligations through the bankruptcy. So you have to, as you're putting money in anything, have to have it in a variety of different places just to make sure that if something does happen to one or two, the other 96 are solvent.
Okay, kind of protect yourself, as you've always
You
said.
must protect
Right.
yourself.
Okay, we're talking about financial challenges in funding your retirement. We have a whole list here that we would like you to, probably a good idea to write these down, but here's the big one, number 3, inflation. We could probably make this 1A, 2A, 3A. We could put this just about everywhere, Stan.
Well, one of our shows that we did earlier was on inflation, and inflation is a factor. And there's all kinds of different inflation, and there's different people have different kinds of inflation. When you're sending kids to college, your inflation is substantially greater than when you're totally retired and you don't have that obligation. You have other obligations to be concerned with, whether it be health, costs for health care. That becomes your inflation factor. When you're 25, you don't have that factor. You don't have the inflation factor of health care. You have the inflation factor of just living and what it costs for a six-pack. I mean, those things are important based on what your age is.
Leo, I was going to ask you, what is the biggest hindrance, I guess, to people fighting inflation with their investment strategy?
What makes it difficult?
Yes.
I think the fact that people often think of inflation as like a sleeping bear. They forget that underneath the bear is sleeping. Inflation doesn't really affect me. That's what they think. I think that's the biggest issue.
So then they kind of ignore it then.
A little ignorance is bliss, so to speak. Ignorance will really kill you later on as far as inflation is concerned. Early on, you're right, in your 20s or 30s, maybe it doesn't. But those are really vital years, strangely enough, towards retirement. If you can start early on putting away money for retirement in your 20s and 30s, you'll be significantly ahead of someone who starts in their 50s.
All right, more to talk about here on the show. It's Molotsky on Money. We are here every week at this time discussing a variety of financial issues, of course, and we have plenty more to talk about tonight. The most important financial challenges to funding your retirement or just merely to save money. With Stan and Lee Molotsky, I'm your host, John DeMasi. We're coming back. More of Molotsky on Money after these words. Don't go away.
Certain times in our lives, it's very important to make sure our brakes are not worn out, and we have an exit strategy in the case of impending volatility in the markets. Don't wait until after your next accident. Test your brakes now. Test your portfolio's risk model now. Make sure you are positioned in order to protect yourself. Avoid the next market crash by having your brakes checked. Call 1-800-MONEY-SHM. That's 1-800-666-3974. The SHM Financial Group has been providing sound, safe, and secure planning for over 50 years. Check your brakes now and be better safe than sorry.
Just as it's extremely important to have your automobile's brakes tested, we think you must have some type of safety net provisions in your financial plan. How are you protecting your bond positions from rising rates? How are you protecting your stock market gains from market sell-off? Do you have the proper provisions in your financial plan to assure that your income lasts as long as you do? Are you keeping up with inflation? Call 1-800-MONEY-SHM to schedule your safety net review. That's 1-800-MONEY-SHM.
Welcome back to this edition of Molotsky on Money. Don't forget, if you would like to contact Stan or Lee Molotsky or any member of the SHM Financial Group during the week, we put the number up on the screen. You can call them at their toll-free number. You can email them. You can go on their website. But they're always happy to talk to you if you have a question or if you'd like to sit down with them and go over your particular situation. Tonight here on the show, we are discussing the most important financial challenges to funding your retirement, and we'll get right back into it here on the program. We've been talking about a lot so far, but we have plenty more to talk about. And this is number 4, personal cost of living. Lee, let me start with you. What does that mean? I mean, does that mean watch your lifestyle, or what do you mean by personal?
It's a little lifestyle question, but it's more pertaining to inflation is a number that the government gives us, whether you believe it or not. Your personal cost of living is really your personal inflation. Are you saving money for a house if you're young? Are you saving money for college for your kids? Are you saving money for retirement if you're a little bit older?
Are you spending too much money, maybe?
Are you spending too much? So that's your personal cost of living. Are you eating out a lot?
Yes.
And if you're eating out a lot, as you know.
That's very expensive, yes.
So that's your personal cost of living. And you have to factor in that every individual's cost of living adjustment should be different. But you have to be aware of the things that are going up in cost.
Stan, how do you guide your clients into something like that where they say, well, I have this and this and this and this, and do you tell them, well, you don't need that because you got to be saving money? I mean, how do you help them with that?
It's very difficult. You just point out that you have certain goals that you want to reach, and how are you going to reach those goals? If the objective is, $500,000 in so many years, or $1 million, or $2 million, how are you going to get to that number? Well, you have to put away a certain amount of dollars on a regular basis at a certain interest rate, to get there. Well, if you can't do it, then therefore you have to eliminate those things that you are doing in order to get to where you want to go, so that you have that, quote, comfortable retirement. So.
Funny you should mention that. Next week our show is going to be about how to be a millionaire.
That's right.
And you're going to
How
show
to live
us.
like a millionaire?
No, how to become a millionaire.
How to become a millionaire.
And this isn't the game show. We're not talking about that.
How to become a
okay. All right. Most important financial challenges to funding your retirement. We're continuing with that theme here tonight on the show. And this is bequest. Stan, what does that mean?
Well, a lot of our clients, they have a certain amount of money that they're using and that they feel that they're going to spend based off the interest from that particular pile of money and the Social Security and maybe a pension or two that they have. The balance of that money is to be left to someone or something. And a lot of our clients are leaving that money to children and grandchildren and great-grandchildren, and to their church or their synagogue or United Way or whatever it is that their specific charity might be. And it's just a matter of structuring how you can best move those dollars to that particular charity or to children and grandchildren. And there are some great vehicles available that can help clients, do that for minimal amounts of dollars.
Such as?
Well, for example, a lot of times people say, gee, I'm really upset that I have to take money out of my IRA plan. In other words, they're over 70 and a half and you have to take money out of that plan. It's called the required minimum distribution. And the older you get, the more percentage-wise you have to take out. And they're saying, well, I don't need that money. I don't know, what do I do with that money? And a lot of times what we've done is structure where they take some of that money, and whether they give it to a charity or they take out an insurance policy on themselves or their spouse or together, and in turn, when they do pass away, then that small amount of money that went into that particular program becomes a substantial amount of money to be paid to their children, grandchildren, or their particular charity that they're so inclined to give money to. So it's just a matter of better utilizing the monies that are available. And they can even take monies from existing programs without a tax liability, shift it over into a program like this, create an income for themselves, and then increase the amount of money that goes to that charity, children, or grandchild.
That's why you do what you do. Of course,
Yes.
that was a great explanation.
Thank you.
Keep
Right.
up the good work.
I'm doing my best.
We're discussing the most important financial challenges to funding your retirement as we continue here on the program. We've had a lot so far, but we have a lot more to tell you. Liquidity sufficient to cover extraordinary events. Lee, would an extraordinary event be like the birth of children or
Twins.
what? Twins or
Why,
something
why,
like that?
why are you asking me
Well,
that question?
because you just so happen to have twins, you know, who are adorable. Can I sneak in a hi, Jenna, hi, Alexa?
Is that an
real quick?
extra?
Okay.
Hello, Jenna. Hello, Alexa.
Yeah.
Is that an extraordinary event?
I would think so.
Okay.
Would
so
you?
yeah, you have to obviously have sufficient assets in order to provide for twins or whomever, you know, however many children you have. But I think what that question pertains, or what that statement pertains to, is unexpected events.
Such as?
A medical issue, having to go into a nursing care facility, having to deal with a problem, a car accident. How are you prepared? Do you have enough assets set aside to deal with the unexpected, so to speak?
So how much should you have
Good question.
to cover an extraordinary event?
Well, you need, again, it's a personal decision, but we want to address that individually with each individual. How much of the monies that you have are set aside for emergency? You have to have, let's say, 6 months worth of emergency monies set aside to live and have for unexpected events.
And if you're, the younger you are, and especially with twins or triplets or individual children, single children or whatever, if you're working, not only do you have the income that you have to have, but there's a protection you should have, which is a case of a disability, where you're not deceased, where the life insurance would pay, but if you're disabled and you can't work, you still have expenses, and if you're still with children, you have to raise them, and there's college and all those things. So it's critical that the younger the person, the more important it is to have some form of disability income, you know, protection.
So the
sorry,
liquidity means some money and also could mean insurance protection.
Absolutely. I mean,
Okay.
you protect your home, you protect your car, you know, you protect against being sued, all that. So why not protect against yourself having a problem and there's no more income that you would have to protect your family? That's
So
critical.
Fast forward from age 30 to age 60, or age 65, or age 70. The 30-year-old needs some kind of disability planning.
No question.
He or she loses or gets
Even if they're
hurt.
not married, they need that.
Right, that's the most important thing.
Of course, how are you going to pay your bills?
Exactly.
So fast forward 30 years to age 60. Now, a 60-year-old needs disability, but he or she is starting to think about what happens if I need care, if I need assisted care or care in my home or long-term care. So long-term care really is a type of disability planning for a little bit more of a mature person.
Okay, we have one more before we go to break. We want to do this one, and this is another important one on the subject of most important financial challenges to funding your retirement: tax confiscation of wealth. What are we talking about here? Are we talking about the IRS? Are we talking about, what are we talking about?
My favorite topic.
I saw you laughing. I was saying, what's he laughing
It's,
about? You know?
It's a combination of different things. You certainly have the tax confiscation, and then you have certain political direction that certain entities take that the more you earn, the more they feel that they are entitled to, which makes it interesting in the planning process, because you then have to make adjustments in the earning capacity from taxable income to shift to tax deferred to tax-free income, so you're not over that particular limit, so you get hit with 3 or 4 additional taxes that are built into the current administration's financing program. So
That's why you were laughing.
Instead of calling it tax compensation, let's call it tax planning.
Yes.
well, that's our job, is to
Your job,
Probably-
your job is to plan so that they don't pay more than what they have to.
well, you know,
Pretty much it?
Exactly. I mean,
Well,
you know,
again, the government has a budget that it supposedly lives by,
Right.
and our job
Right.
as planners is to sit down with an individual or couples and help them look at their loaf of bread and divide it up properly so that it's best for them.
But, and again, and part of the planning process, I mean, Lee and I are not accountants, or CPAs. We have tax background, but we're not CPAs per se. But our job is to show the client, we all know, we all understand, we live in the greatest country that has ever been assembled on the face of the earth. No question about it. And we all feel obligated, I think, to pay our fair share of tax dollars. Our job is to make sure that our clients don't pay more than their fair share. And that's our job, to show them different things that they can do to minimize their tax obligation, to maximize their income for themselves.
Okay, more to talk about here on the show. It's Molotsky on Money. We're here every week at this time, and we're discussing the most important financial challenges to funding your retirement. Yes, we do have more to talk about, and some of your questions as well. With Stan and Lee Molotsky, I'm your host, John DeMasi. More of this edition of Molotsky on Money after these words. Stay right there.
Do you know what your risk tolerance is when it comes to your investments? Do you know exactly what you have in your portfolio? The SHM Financial Group have developed a very important program called a financial stress test. It's simple, quick, and can help you in your future financial plans. Contact the SHM Financial Group to schedule it. Offices in Collingswood, Voorhees, and Lakehurst, New Jersey. Call 1-800-MONEY-SHM. That's 1-800-666-3974. Call us to discuss the reverse mortgage concept. If you should decide to proceed, you're required to go through a 60-minute phone or office interview. We will provide you with a list of HUD counselors you can call who will provide you with the counseling. Call us at 1-855-HUD-REVERSE. That's 1-855-483-7383.
Welcome back to Molotsky on Money. Don't forget, if you'd like to reach Stan or Lee Molotsky or any member of the SHM Financial Group during the week, feel free to call them. We have the toll-free number on the screen. You could email them, or you can go on their website and get a lot of information. But if you really want to talk to them, give them a call. They'll be happy to sit down with you. Remember, the initial consultation with Stan and Lee Molotsky is complimentary, so take advantage of that. Give them a call. They'll be happy to talk to you. Tonight here on Molotsky on Money, we are discussing the most important financial challenges in funding your retirement. And as I've said many times, we have a lot of those challenges tonight. We're trying to give them all to you as much as we can here on the program. And let's continue with where we left off. And this is, hopefully you don't get into this, litigation risk. Lee, I mean, is that, how do you protect against that?
I think it's more of a legal question than it is a financial estate planning question, but what you don't want to do, and we've run into this many times in the past, where parents give children money. Parents give the house or the title of the house to the children, or they're jointly in an account with a child. If the child gets into an accident or has an issue and somebody sues the child on a joint account with the parent has as much obligation as the child does. So you want to
That's
be
what
careful.
you're talking about, litigation risk.
Part of it.
Yeah, you want to be
That's part of it,
careful
okay.
how your assets are titled.
Well, not only the titling of the assets, but the protection of those assets. I mean, unfortunately today, people sue people just at the blink of an eye. So you have to make sure that you have enough, liability coverage, so if somebody trips on your sidewalk or, falls on your lawn and sues you, that you're covered and that your other assets are protected. So you need a certain amount of protection. And that's, again, part of the planning process. It's as important as having a will and the powers of attorney and those kinds of things.
And again, it's not our area of expertise, but it's called an umbrella insurance policy.
Right.
So it's
Critical.
really important to update or have
What does that mean, by the way?
an umbrella, again, not my area of expertise, but it protects those perils that are unprotected by
Your normal
homeowners insurance.
homeowners, it's the umbrella above the homeowner coverage that has
I think
basic
it's
coverage.
other than homeowners, something to that effect.
Well, in addition to, on top
Yeah,
of.
in addition to.
And another way to avoid litigation risk is to marry a lawyer, correct? Isn't that another way to
Not
do it?
necessarily. Not necessarily at all.
Marry a practicing lawyer.
Practically, okay, all right. That's a little inside joke. We'll tell you about it someday. Moving along here, the most important financial challenges to funding your retirement. This is diminished investment capacity. Stan, by this, you'll explain it, of course, but does it mean that your investments are diminishing, maybe because you took too much out? You weren't paying attention to what was happening?
I think it's more the
Yes, it's more of the individual.
ability.
Right. The older people get, the more mature they get, the older they get, the less they are in their ability to do the things they did when they were younger, as far as looking and developing and analyzing the particular investment things that they want to go into. So as one gets older, they need more help in guidance as to the kinds of things that they should deposit their money into. When we sit down with a mature client, we try and insist that the son or the daughter or both come with them as part of the discussion, or at least we present to the son or the daughter what we've presented, to the parents, so that they are familiar with what we are in turn presenting, so that they can in turn help them as well.
See, I actually thought where you were going with the diminished investment capacity was the later you are in the game, the less you have time, less innings in the game you have to come back from a deficit.
Right.
Well, I'm looking at it from the other way.
Yeah.
The less innings you have left in the game, as you get older, you have less interest in looking at all of the neat things that are actually out there and available today. I mean, there's so many.
That's why the
terrific-
son and daughter comes in, or the right,
well,
somebody. Okay.
exactly, just
All
to
right.
make people aware of these are things that didn't exist 3-4 years ago, that maybe is something that you should be considering today.
Okay, we have one more to cover for you here on the program tonight before we leave you. The most important financial challenges to funding your retirement. We love this one.
Yeah, what does that
Protection from the kids. What does that mean, Stan?
What does that mean?
Well, Lee mentioned before, I mean, sometimes they have powers of attorney to do certain things, and fortunately, in our practice, in our experience, it rarely does, the child or the grandchild take advantage of that, power of attorney. But it's sometimes when the parent or the grandparent puts assets in joint name, let's say a parent with a child, like Lee mentioned before, and then that child gets sued, or that child gets a divorce, and part of that asset that's in his or her name becomes part of the divorce settlement, even though it belonged to the parent, because they shifted the money into that account for ease and safety. So those are the kinds of things that people have to be aware of, and that's why it's important that they meet and sit with an attorney every so often, just to go over their will and powers of attorney and these kinds of things before they go rush to do that type of
So
stuff.
protection for the kids, Lee, would an attorney be involved? Would you have legal documents or those kinds of things?
Yeah, just let the kids know, or the parents know, the ramifications of putting monies in joint with a child or grandchild or whatever.
Okay, that's going to put the wraps on another edition of Molotsky on Money. Don't forget, if you would like to contact Stan or Lee Molotsky at the SHM Financial Group, toll-free number was on the screen. We hope you wrote it down. Email or website, feel free to contact them any which way. For Stan and Lee Molotsky, I'm your host, John DeMasi. Always a pleasure. Thanks for watching. Good night, Alexa. Good night, Janet. We'll talk to you next week. Molotsky on Money right here. Take care.
Just as it's extremely important to have your automobile's brakes tested, we think you must have some type of safety net provisions in your financial plan. How are you protecting your bond positions from rising rates? How are you protecting your stock market gains from market sell-off? Do you have the proper provisions in your financial plan to assure that your income lasts as long as you do? Are you keeping up with inflation? Call 1-800-MONEY-SHM to schedule your safety net review. That's 1-800-MONEY-SHM. Not everyone can endure the ups and downs of the market. When planning for retirement, you can ride the roller coaster and take your chances, or you can eliminate the downs by properly repositioning most of your portfolio. If you're 5 years pre-retirement or 5 to 10 years into retirement, it's not too late. As a matter of fact, it's never too late to avoid the next down movement. Call the SHM Financial Group at 1-800-MONEY-SHM or check us out on the web at shmfinancial.com.